sword to the back teeth of talking about inflation, but it hasn't gone away yet. And the reason why inflation will remain an important factor is because that will largely dictate what central banks do with interest rates. And of course, interest rates underpin the valuation methodologies for most, if not all, assets. And so inflation will remain important, and therefore so will interest rates. But we think those will likely fade in importance as the year goes on. And we'll start getting a better feel for what the new world really looks like. There's a very large spread of views as to what's going to happen over the next year. And that happens quite regularly in markets, but particularly at market turning points or where you've changed into a different environment as we have done this time around. And so what that says to us is there's no clear consensus in the market. And so that's likely to mean that we're going to have high levels of volatility as people try and over extrapolate individual data points. You might get an inflation figure that comes out a little bit lower than expected. Markets will rally off the back of that in the anticipation that that will mean interest rates will come down earlier. And then of course you might, on the next print, get the exact opposite. So that volatility is likely to remain high. Now, volatility can be really advantageous for an investor. It means that you get the opportunity to sell out of assets that you might want to move on at higher prices in those those periods of optimism. And it also means you've got opportunities to buy in good assets at lower prices during those bouts of pessimism. And so the way we're approaching this is not to be too bold. We don't really want to make any strong position taking throughout the year. What we're likely to do is be very data dependent and try and be a little bit opportunistic, making changes only when there's a clear advantage in doing so. But at the meantime, sort of, playing very close, not taking on any risk in portfolios that isn't a clear value generator for us. With the move to decarbonise economies, which is genuinely picking up pace and is encouraging. It's still probably not at the speed it needs to be, but it's we're making big strides in the right direction. One of the impacts is, of course, what that's doing to the pricing of commodities. And we've actually implemented at least one trade that's sympathetic of that in portfolios, where we bought a copper miner within our direct equity strategies, because it's that recognition that whilst we are moving to a more electrified world, you're going to need a lot more copper so that you can run those cables. I guess there's a certain level of irony in the whole thing, which is, traditionally, when you think about the environment, you are quite negative about the mining sector. However, the mining sector is going to be crucial for us to complete this decarbonisation. So you're going to have to probably accept that you're going to need to have either exposure to miners, or at least recognise that miners are going to be part of the solution. I think the two things that I would draw out at the moment is it's probably going through a bit of a growing pain at the moment, in the sense of that sort of large engagement with ESG as a broad theme has had a lot of strong momentum. And what we're now getting is two sort of, I guess, headwinds, or two things that are pushing back against that. We probably will have seen the news flow out of the US, where particularly people within the Republican Party, particularly those from states associated with fossil fuels, those sort of Texas type states, where that the economy is built on a lot of oil and energy production. We're seeing some strong pushback against ESG factors being included, and to the extent where you're seeing state pension funds in those areas being restricted from using managers that have ESG strategies. In addition, because that ESG theme has become, I guess, hot in a sense, you've seen a lot of greenwashing, and that's sort of leading to a bit of a reflection on looking at those managers who are claiming to be ESG fund managers and determining, are they really doing what they're doing, or is it a cynical marketing ploy? And so, as you have with any period of expansion in any area or in any theme, We've seen a massive amount of growth, but now we're just seeing maybe a little bit of a point of reflection, a point of contemplation before we move on to that next phase.